So I'm honoured to be here as a Richard Musgrave lecturer for this year. I'd like to thank Clements, Joel and Monica for inviting me to be here. I was not taught by Richard Musgrave. I met him once or twice, briefly, and but I, as everybody else in the room probably learnt a lot from him and from his work. He's not only one of the greatest figures in public finance in the 20th century, he's one of the greatest economists in the 20th century, and we all owe him a great debt, and it's a huge honour to be here giving a Richard Musgrave lecture. So thank you very much for that honour, and thank you to Clements and Joel for your kind words. I think I do have a citation for the balloon, but I'll give you that later over dinner, rather than spending all our time trying to discuss that right now. I've also had long association with both CESifo and the IIPF in various capacities. With CESifo, I was a member of the European Economic Advisory Group with Hans Werner for several years. That was our excuse for going to the Oktoberfest, and which you now know more about than I had anticipated. And also with the IIPF, of course. In fact, only I think 5 years ago, I was actually here giving the laudation for Joel, actually. So that was it's quite interesting reversal of roles in this case. So what I thought I'd do today is to give you a kind of overview of what I think about the ways that we tax profit in the international economy and international profit. I kind of was trying to figure out whether it'd be best to kind of focus on one particular aspect or another, whether I could spend the entire hour talking about the destination-based cash flow tax, which would certainly have been possible. But I thought I'd try and set it in context, really. And I know there's quite a lot of people who worked in international tax in the room who probably know more than I do about this. What I hope might be of use would just be to give that kind of big bird's eye view from kind of 35,000 feet. It's kind of where are we? And this really relates not only to the academic work which is being done, but also to the policy work which is taking place in various dimensions and in various places at the moment through the OECD, the European Commission, the IMF, and various individual countries. There's actually quite a lot going on at the moment, and I think it'd be quite useful to kind of bring all that together. At least I hope it will be, and you would find that useful. The work that I'm going to be talking about is to some extent built around a group which we call the International Tax Group. That's one of the names we call it. So I invited a few years ago, just as the OECD was starting its project, I invited a few people, for economists and lawyers, to join a group where we would actually focus really on the international tax and think about the structure of the existing system and ways in which it could be profitably reformed. I'm delighted that I managed to put together a great group of economists and lawyers. The economists are the two other economists on this group are two previous Musgrave lecturers, Alan Auerbach and Michael Keane. We also have currently three lawyers, one of whom is Wolfgang Schön from the Max Planck Institute here. He's not here today, but Kai is here, so it's good to see you, Kai. And another, Paul Oosterhuis, who's in practice in the US, works for Skadden Arps, and one of my colleagues from Oxford, John Vella. So together we've been meeting now for rather longer than I had hoped to try and put together our ideas of this and actually write them down and present them to the world. I think we're quite close to the end. To some extent, this was a kind of based on the kind of Merlier's review that the IFS did, and like the Merlier's review, it's gone on much longer than we anticipated. But actually, a closer analogy is actually with the IFS Capital Taxes Group, much longer ago, of which I was a member and of which Malcolm Gammy was the chair, which actually had a number of reports in the around 1990, 1991. And that was a group of economists and lawyers. And I think I learned from that actually, thinking about tax policy, you really need to go, much deeper than the economists normally go. But actually, from the lawyer's perspective, you actually need to think of the big picture as well. So that's what we've been trying to do. There are some things on our website which are, outlining some of the things we've thought about. I hope there's much more to come in the relatively near future. So this is what I thought I'd talk about broadly. So this bird's eye view, I really want to go back and think about, where are we with the existing system? In particular, what are the economic principles which underlie the existing system? That is, if we can think of any economic principles which might be related to the existing system, which could be quite hard. And think about some of the problems of the existing system. And then having done that, obviously the kind of natural path from there is to say, well, kind of how could we improve it? And we could think of that in two different kinds of ways. I think one is to say, let's take the existing system. Can we think of ways in which we could make it better? But, broadly keeping it the same, but adjust it in some way. So that's kind of one approach. And the other approach is, let's ignore the existing system for a moment and let's think about, what would a good international tax system look like? And then think about, is it possible to get to there from here? And part of that process is actually going to be what I've written down there. The second bullet point is, actually, do we need a business level tax on profit at all? Joel says that I've been focused on this for many years, which is kind of true, I suppose, up to a point. So, this could put me out of business if we decide that we don't need one. And actually, I think, the rationale for having one isn't very strong, actually. So I'm looking forward to my retirement. But let's start with the existing system. So where do we start? We start with the 1920s. So this is, I think it's kind of commonly agreed that this is where it all kicked off. There was a group of economists set up by the League of Nations in the 1920s to try and basically come up with a view of how we should tax, what we now think of as multinational companies, but really kind of any activities which are taking place across national borders. And what these guys came up with in the 1920s was this compromise between residence and source. So the idea was, there are places where there's kind of investors, there are places where there's economic activity. Both of those have some claim on taxing any profit arises that may arise from that activity. So here's a way of making a compromise. We'll give some rights to quotes the source country, and we'll give some quotes the residence country. And we'll do that by giving them rights to tax different kinds of income. So active income is kind of broadly profit before all that passive income, things like interest, royalties, and dividends. So that's the kind of basic idea. It hasn't really changed very much in the last 100 years since then. I mean, it's clearly developed. Lots of things have developed since then. It's got immensely more complicated, but that's still basically the structure. And that's still basically, if you just look at that and understand that that's what the international tax system is trying to do, you'll have a good idea of why it doesn't work. So first of all, we need to define what source is. We need to find out what residence is. And then we have to figure out the difference between active and passive income. We also have to figure out, when two elements of a multinational company are trading with each other, what's the appropriate price that they should do that? Because, we still need to figure out that either from the perspective of source or residence. I think that's where we were until 2015 or 2013. So in 2013, the OECD finally, after considerable political pressure, basically agreed that actually this system wasn't working terribly well. So the initial idea of this system was that we should prevent double taxation. We didn't want the source country to tax its profit and the residence country to tax its profit. What the OECD then discovered had happened was actually what they call double non-taxation, or what anybody else might just call non-taxation, is actually multinationals are not paying any tax at all anywhere. And so the BEPS action plan, BEPS stands for Base Erosion and Profit Shifting, if you're not an aficionado of this stuff. So the base erosion and profit shifting is basically a kind of clue to what they thought the problem was. And actually the profit being made in some high tax jurisdictions actually being shipped off to some low tax jurisdiction and thereby avoiding tax. So the BEPS action plan, I think there are 15 reports, all on different actions within the international tax system. Each one is pretty long. If you add them all together, there's several thousand pages of proposals from the OECD. You'll be glad to know I'm not going to go through them at all. The only thing I want to mention out of that is, is there any principle that the OECD is using that's different? And I think there is. I think, well, up to a point at least. The principle which kind of shines through from that work that they've done more recently is that income should be taxed in the place of value creation. I don't know quite what that means, but I'm not sure anybody else does either. In fact, that's another thing we could discuss over dinner when we've done with balloons. But that's if it means anything, there's some kind of concept where value is created in Munich, therefore the Germans should get to tax it. We need to figure out, as far as I can see value creation, you need, and I would start this by saying, let's go to a supply and demand curve diagram. You need somebody to supply something, you need somebody to buy it, and that kind of create some consumer and producer surplus. That could all be happening in lots of different places. So it's not entirely clear how we're going to use the concept of value creation. I think the thing which kind of is notable, though, is that you would search in vain for anything in the BEPS action plans which said, we're now changing our fundamental principles. We're changing from the 1920s principles to the notion of value creation. There's no discussion of it at all. It's just kind of laid out there as being, well, this is obviously what we do. I think if you just look at those things on the side, it's clearly apparent that they're not the same thing. And so it's entirely unclear what principles the OECD or indeed anybody else is really using for the international tax system. So I call this the Marxist approach to international tax system. This is not Karl Marx, this is Groucho Marx. So as Groucho Marx said, those are my principles. If you don't like them, I have others. So I think this is very much the OECD approach. I do realise that there are millions of people watching me, many of them from the OECD right at the moment, so I should apologise straight away. So let's go a bit beyond where we were in the 1920s. This is the kind of what I think of when I think of the 1920s approach. There's a residence country and there's a source country, and pretty broadly we have investors in the residence country and economic activity in the source country. May seem a bit simpler. Actually, that's where most economic models start, and actually it's where most economic models finish as well, actually. We usually start with a two-country model. There's something happening in each country, and we figure out how we, in the tax world, we then think about how to tax that. Here's a slightly more complicated model, not much more complicated, but it has 4 places rather than 2. And you can see so we have shareholders, they could be anywhere in the world. Think of this as a multinational company. There's a parent company, which is probably just in one place. They have activities in all kinds of legal forms. So it could be subsidiaries, branches, permanent establishments, anything else that a multinational company may have, joint activities, where they do all the stuff: management, R&D, production, marketing, finance, so on, and ownership. That's quite important. And then they have customers. And they could be anywhere in the world as well. Okay, so let's think about this modern multinational and ask the question, if we're trying to apply the 1920s approach to this, where's residence and source? So how does the international tax system actually tax this multinational? You might think, okay, residence is obviously where the shareholders are, maybe where the parent company is. Source, well, somewhere between activities and customers. That would kind of be a bit like, we might be thinking about it in the 1920s. Actually, it's not, none of that's true. I mean, the residence and source is all in the activities column. And this multinational may have 2 subsidiaries, one in country A, one in country B. If country B pays interest to country A, then country B is the source country and country A is the residence country. That seems like a million miles away from where we started in the 1920s, but that's broadly what we have now. So the concept of residence and source that we are dealing with in the international tax system at the moment is just kind of miles away from anything you might actually think about like being kind of really residence and source in the kind of 1920s sense. And I think what's happened since the 1920s is essentially intermediate companies. So the parent company, which could be in the US, for example, will have lots of subsidiaries around the world. Some of those it's going to put into tax havens and pay money to those tax havens, and they become the residence countries. So I think what the designers of this system kind of didn't notice and didn't realize would happen was actually that we're going to have that kind of problem. We're going to set at intermediate companies, then the whole system effectively breaks down. I think that's what the OECD has been trying to fix. But instead of going back to the kind of fundamental principles and saying, okay, well, how might we fix this? They're really trying to keep the kind of basic structure, but kind of close some loopholes, I think. So let me just talk about a couple of problems with the existing system, which strike me as particularly egregious, and mainly because they have very little rationale. So, and I'm just going to pick on 2. We could spend a lot of time on this, but we don't want to get too bogged down. But one is debt and equity. So everybody knows that, business tax systems, corporation tax treat debt more favourably than equity. If you're a business, you borrow and you pay interest, you get a tax deduction for the interest cost. There's no equivalent relief for the cost of equity finance. So I think there's as far as I know, in my entire career, I don't think I've ever come across an economist arguing in favour of this. Economists are pretty unanimously would argue that actually we should not distinguish between debt and equity finance. Nevertheless, that's what we do. So let's kind of take this a step forward, further into the international tax sphere. How can we use this for tax planning? Well, it's pretty easy. I've already described it. We have one subsidiary in a tax haven. We have another subsidiary that's in a high tax country like Germany. The subsidiary in Germany pays interest to the tax haven. You get a tax saving in Germany at a relatively high tax rate. In principle, you pay tax on the interest received in the tax haven, but if there is no tax there, then you don't. So you manage to shift your profits pretty easily into a tax haven. We can make that more sophisticated. We can have hybrid financial instruments which start off as debt in Germany, but maybe it's kind of paid to another high tax country like France. But the nature of this hybrid financial instrument is that if you look at it from the German perspective, it's going to be debt, so you get the interest relief. If you look at it from the French perspective, it turns out to be equity, and so when it arrives when it crosses the border, it turns into a dividend, and then it's not taxed in France either. So these are kind of slightly more sophisticated ways of doing this, and there are lots of anti-avoidance rules which try and prevent some of these things. So there's the controlled foreign company rules which say, okay, that interest which has just arisen in the tax haven, we're going to tax anyway, perhaps. And we have restrictions on interest relief. Now, the OECD BEPS project had a number of things. This has, I think it's about 450 pages on how to deal with hybrid financial instruments, which is so complicated, I bet there's nobody in the room who would claim to understand it. I'm not even sure there's any of the millions watching on this live stream. I'd like to know how many of those understand it. I suspect it's relatively few. On the other hand, the arbitrary restriction on interest relief, okay, we may not like this. It's pretty arbitrary. It says basically, this is from the German rule, which says, you're not allowed to deduct interest more than 30% of your profit. We measure profit in some way, EBITDA. And so you take 30%, that's what you're allowed. The rest of it, you're not allowed. Now, to an economist, that's pretty straightforward. That's surely at least simple. We're not going to mess up the system and make it any more complicated. Okay, here's a question for you. So the UK has now implemented this rule, which says you can't have a deduction for interest more than 30% of your profit. How much tax legislation do you think that takes up? Kind of, maybe a paragraph, page, maybe a page or two. This is on top of all the stuff we already have. We already define what interest is and all those kind of things. Anybody like to guess how many pages of tax legislation there are in the UK which implementing this simple rule? Joel, how many? 238. Yeah, it's 159, but it's going up because they've now had to change it a bit. But on top of that, there's also guidance from the HMRC, the tax authority, which tells you how they plan to interpret this legislation. And there's another 577 pages of guidance as to how to interpret this. So this, what starts off as a pretty simple idea, it's got amazingly complex already. People can do nothing else other than just kind of try and figure out what's going on. That's the kind of nature of the beast. This is a simple thing. When we talk about complexity, this is the simple bit. If you're trying to implement, rules for hybrid financial instruments, it's much more complicated. So that's debt and equity. And the other is the arm's length principle. And the arm's length principle is a kind of fundamental element of the international tax system. It doesn't actually go back to the 1920s. I think it started in the 1960s. The basic idea is, if you have transactions between two related parties that are part of the same multinational company, we have to figure out what is a reasonable price for that transaction. They could be just buying a widget from each other. One could be paying a royalty to another or paying interest. In any of those cases, we need to figure out exactly what the appropriate price is. And the arm's length principle says, okay, well, the price should be the price at which two independent parties would contract over that, whatever it is that's being bought and sold. So that's kind of pretty straightforward. May seem quite reasonable. And back in the 1960s, it probably did seem reasonable. I think it still seems reasonable to a lot of people. The problem is that it kind of creates quite significant problems, I think. The most significant problem, I think, is that actually multinationals are not like other companies. Otherwise they wouldn't be multinationals. They're multinationals for a variety of reasons, one of which they make higher profit because they're multinationals, because they can exploit supply chain advantages, for example. There's all kinds of ways in which multinationals may be different. there's a big literature on the extent to which multinationals are more profitable than purely domestic companies. Here's a quote from just kind of one paper by Nick Bloom and co-authors in the AER about productivity. So US multinationals in the UK, according to Nick Bloom and his colleagues, were 42% more productive than UK domestic firms. So what's the implication of that when we think about arm's length pricing is you're unlikely to get it right, or at least it's not clear what the right answer is. What you're likely to achieve by looking at some independent operators is what domestic firms do and the prices that they use. So what you're going to identify is what I'm going to call routine profit, which is the kind of profit which a kind of purely domestic firm might earn. The problem is that actually multinational companies tend to make much higher profit than that. And the OECD has recognised that. There's kind of work in the OECD about how to deal with so-called synergies, which kind of basically allow for the fact that profits may be higher. But actually, it seems to me that this is a kind of fundamental part of the problem of taxing multinationals, and actually just because they're different. The case of risk is a particularly difficult problem within the arm's length principle, because we start off with the principle that we want to treat these two related parties as if they were independent. Now let's think of two independent parties, contracting with each other in a risky business. So I'm contracting with Joel, and we have some risky business. Now, Joel could take the risk, or I could take the risk. I could guarantee Joel a price, in which case I'd be taking all the risk, and Joel would not be taking the risk. With two independent people, that seems, perfectly reasonable. Okay, but let's now make them related. So suppose that Joel and I are both subsidiaries owned by the same multinational company. Now, does it make any more sense now to say that Joel takes the risk or I take the risk? It seems to me that we have to take a step back and say, well, what do we actually mean by bearing the risk? And what we mean by bearing the risk is actually the shareholders of Joel's company bear the risk, or the shareholders of my company bears the risk. Now, if those are different people, then it may make sense. Joel, if I'm taking the risk, my shareholders are going to demand a higher required rate of return to compensate them for that risk. That's going to affect the pricing that we deal at. Actually, if Joel's company and my company are both owned by the same shareholders, it doesn't really make any sense to think about risk at all. But this is a kind of fundamental part of the ways that multinational companies shift profits around by using risk. The OECD recognised this. So sorry the OECD if you're watching, but what does the OECD respond by saying, okay, what the BEPS proposal says, okay, we recognise the problem, we're going to identify risk as where the person managing that risk is, or where the person controls that risk is. That's going to be where the risk is. Well, sorry, but it seems unconvincing that that's really where the risk is. Where the risk is where your shareholders are. It really doesn't make any sense to identify risk as being where the manager is. Well, I'll shift the manager to the Cayman Islands, and he can, I'll buy him a flat and that'll be fine. He can live there and enjoy the beaches. That really is not identifying risk any more than we were doing before. So I think this is a problem whereby actually the kind of insistence on saying the way we treat related parties should be the same as the way we treat independent parties is actually going to let us down. Because actually related party business and independent party business is actually completely different in this case, and we need to recognise that. So those are kind of two of the kind of bigger problems, I think, which kind of go to the some of the heart of the international tax system. We could have an overview of the problems here. This is kind of a bit more general. There's clearly a problem of avoidance, and I've talked about some of those. There's clearly also problems of inefficiency. There's been lots of work done now on ways in which taxes affect business behaviour, the distortions of scale and location of activity, of competitiveness, sources, use and finance, many other things as well. The implementation is clearly complex, it's clearly uncertain, it's clearly extremely costly, and there's some work on that. There could be a lot more work on that. And there's instability. So Joel mentioned tax competition. Here's a picture which, if you've ever been to any talk on corporation tax at all, you will have seen this picture, which basically says, corporation tax rates have been coming down for an awfully long time. This goes back to 1990. This is the G20 average corporation tax rates. One's an unweighted average, one's a weighted average. It's quite interesting, the US tax reform is there right at the end for the weighted average case. The US has a big weight in their weighted average, and so the US reform on its own has reduced this weighted average quite a lot. But both of these have come down by 20 percentage points since 1990. I think it's quite interesting that at any point in time, if you'd have asked people in the tax policy debate, what do you think is going to happen to tax rates in the future? They all say, oh, well, it's going to stop now. I was involved in the Rudin Committee in 1990, which proposed a minimum tax rate of 30%. But no, 10 years later, people were saying, okay, well, it's not going to go much below 30 or 25. Now people are saying it's not going to go below 15. But actually, if you draw a straight line through this, it's going to hit zero. Well, actually, the axis only goes down to 20, unfortunately, to make it look more dramatic. But you can kind of figure out where it's going to hit zero at some point in the future. So that's our instability problem. So what we'd like is a tax system which is at least not quite so bad on all these criteria. And the OECD BEPS proposals were really, they were focused on the avoidance issue. They weren't really focused on anything else. Okay, so what should we do about this? As economists, I'm mostly economists in the room, there may be some others, but what do we do as economists? Well, one is that we need to do empirical work to kind of identify the scale of these problems. And it's all right to kind of pointing them out, are they big or small? And there's been a lot of work on that over, the last 10 or 20 years, but especially over the last 10 years as increasing, as data becomes more available. I think we've made great strides in finding out about the scale of these things. Though there's still quite a lot we don't know. We really don't know exactly, the scale of international profit shifting. There are some pretty broad estimates out there, but we need to know much more about that, really. So that's kind of one set of things we should be doing. I think another set of things that they're doing is actually very interesting about, how do reform of the international tax system happen? There are lots of players in this game. There are people like the Tax Justice Network, Oxfam and others who are complaining that multinational companies don't pay enough tax. There are politicians who get involved in that saying multinationals are not paying enough tax. And then, then what do they do? The problem is this, this is pretty complex, and the people who can actually come up with a proposal as to this is what we should do are probably people who have actually been working in corporate tax all their lives. That's because it's too complicated. So if you go to the OECD meetings, for example, where we're thinking about, the OECD Model Tax Treaty, which is kind of the kind of home of where this is taking place mostly. There's some in the UN and the IMF as well. Who are the people at those meetings? They're people, they're the tax guys from governments. It's not the politicians who, would much rather send their tax guys to think about how we're going to sort out corporation tax. So I think there's kind of interesting things about complexity, the role of experts. It's clearly path dependence because we are where we are, and we've kind of been developing this for a long time. But I think there's actually lots of scope for kind of more research, just thinking about, how it is that we, how we can change the international tax system, and, what are the constraints and how would we have to go about changing it? And, that kind of political economy work is, I think, could be very interesting. I think there's very little of it in this kind of field. And then the other thing which I actually want to talk about mostly here is to identify options to reform. So I've kind of dissed the existing system and told you some of the things that I think is bad about it. Where do we go from here? And I think a starting point for that is to ask the question, actually, do we need this tax at all? Do we need a business level tax as opposed to kind of individual level taxes on business profits? So let me address that. So, what are some possible rationales for a business level tax on profit? And, if we think any of these are good rationales, what kind of tax would they justify? What would the structure of the tax system look like? So I've got three, and we could write down others. These are three that I thought were worth talking about. There are others out there in the literature which I didn't think was so worth talking about, but please raise them later if we have time. So it's basically ability to pay, a benefit principle, and can we have a lump sum tax? Those are the three ideas here. But let me talk about them a bit more. So the ability to pay thing, comes back to whether I've been talking about business level taxes, but we could also think of it in this context as a kind of corporation tax. Is the corporation tax just there as a backstop for personal income tax? The idea is that actually what we'd like to tax is individuals' capital income. There's a problem there because some of individuals' capital of income might be tied up in businesses. And in corporations in particular, it might be the profits may be retained in the business. So, my wealth may be going up, but it's all in this business. I haven't actually, received the money in terms of cash yet. So, perhaps we could tax the business instead. Or we might think of this as a kind of anti-avoidance device, that actually there's an incentive for me. If we're not taxing business, there'd be an incentive for me to set up a business, set up a contract between the business that I own and Oxford University. Oxford University can pay my salary to the business, and if there's no tax on that business, I can accumulate wealth tax-free in that business. So the argument is we need a corporation tax as an anti-avoidance device and to support the income tax. Well, if that's the story, then it's an extraordinarily complicated anti-avoidance device, which is is much more complicated than the initial tax that you're trying to support in the first place, for some of the reasons that I've been talking about. So that's kind of one problem with that. I think the other problem is that actually it just doesn't work in an international setting. It's actually not a very good backstop for personal income tax. So here's some numbers. So in the US, so Steve Rosenthal and Lydia Austin did some work looking at what's the proportion of US shares and corporate stock, which actually would be taxed. It's basically has to be owned directly by individuals, by US individuals. So, so this is kind of what would be taxed by US individuals of that US stock. And, back in 1965, that's 85% of corporate stock was owned by individuals and would otherwise have been taxed in the personal income tax. Now it's down to 24%. They have a very nice diagram here, which I've taken straight from their publication. So there's really two things going on here. The first thing is there's much more foreign ownership of US stock, and but the US is a relatively closed economy. We're going to see much more bigger numbers. You may have seen it already. So something like, I think it's roughly 25% of US corporate stock is owned by foreigners. So they don't pay US personal income tax anyway. The next big tranche of it is tax preferred forms of saving in the US. So in particular through different kinds of pension plans. So most kinds of savings go into tax preferred assets, as we know that, and this is a problem the world over, where we have a problem with the taxation of savings much more generally, where we tax different forms of savings in different ways, and not surprisingly, people tend to choose forms of savings which are tax preferred. So if you take those out as well as saying, actually, these wouldn't be taxed under personal income tax anyway because they're through a pension fund, what we're left with is about a quarter. If we look at the UK and Germany, so roughly 54% of the UK listed companies are now owned by foreigners, and in Germany about 56% of the DAX 30 is foreign owned as well. So even leaving aside the kind of tax preferred bit, and actually the international portfolio investment is really a big deal. It's no longer the case that you can think, okay, I'm supporting the UK income tax by having a UK corporation tax. What the UK corporation tax is taxing companies which are effectively doing business in the UK. It's not taxing companies which are owned by UK citizens. And if I own companies in Mozambique or Germany or China, then the UK doesn't get to tax those anyway. So, as a protection for the personal income tax on capital income, I say it doesn't do a very good job. It's not a very good rationale for keeping a business level tax. Okay, so what's next then? So the benefit principle. Let's suppose, actually this is a bit closer to justifying the existing system in the way that it currently operates, which is to say, let's think about, okay, companies which are actually resident and located and doing business in the UK. They make use of publicly provided goods and services by the UK government. It seems reasonable that they should make a contribution to the cost of those publicly provided goods and services. The same would be true in anywhere else in Germany or any other example. So that seems like a much better, rationale, at least something which is, and something closer to the existing system. We might even think it's related to value added and so on, but that's another issue. I think my response to this is to ask the question, well, actually, is profit the best base for this? Really, is there a correlation? Is there much of a correlation between the amount of profit a business makes and its use of publicly provided goods and services? I don't know of any research which tries to examine that. I think that's another interesting question. It may be kind of difficult to pick out, but it's quite easy to think of examples of companies which may be making quite big use of publicly provided goods and services but don't make any profit, for example. And actually, isn't it much more likely that large companies are going to be making better use of publicly provided goods and services than small companies? But those large companies may not actually be making any profit. So I think even if there was a correlation, we've already seen taxing profit, trying to identify how much profit is actually generated in this particular jurisdiction is pretty hard to do. So surely, if all we're trying to do is to kind of raise some kind of fee as a compensation for the use of publicly provided goods and services, can't we use something a bit simpler? And I say like something related to size, for example, capital, labour, something like that would seem to me to be kind of more sensible. I mean, the kind of complications of the existing system seem to be unnecessary if this is the aim that we're trying to meet. Okay, so that's the benefit principle. Third, so this is, could this be a lump sum tax is the question. Could it be efficient? Okay, from where we've got to so far, the answer must seem pretty unlikely. It's clearly, a million miles from being a lump sum tax at the moment. So could we turn it into one? And so I want to come back to this. This is the destination-based cash flow tax, which Joel mentioned. So in principle, what would we need to do? So there's been a literature on this, in the context of taxing profit for many years, going back certainly decades, certainly going back to the Mead Committee and before that in the 1970s. What the Mead Committee was proposing was a tax on economic rent, and the idea if you're just taxing economic rent, then it shouldn't have any distortions. However, in an international context, we may also think about location decisions, and so I think we have to think about taxing economic rent, in a place where there's something immobile that we can focus on. That's the basic idea. I'm going to come back to this later towards the end. Of course, it would have to, not only would it need to be efficient, it would have to meet the other criteria, as Joel mentioned as well. All the things would have to be robust to avoidance. It would have to be some kind of fairness, but it would have to be implementable and so on. If we could identify a tax like that, then that would give us a kind of a way of thinking about how we should be taxing it, and also give us a way of thinking about how it should relate to other taxes. So before getting onto that and onto reforms, let me think about where instead we seem to be going, which is saying we should be taxing the place of value creation, and I want to ask the question whether that has any merit. Because the reason I'm asking this is really because that's where the public policy debate has really gone with a vengeance over the last year or two. It came out in the BEPS proposals, but now it's everywhere. You can't actually make a policy proposal unless you say this is because this is where value is created. So as an example, the UK issued a consultation document about the taxation of big digital companies, which my next slide is on. And they explicitly said, we should be taxing these in the place of value creation. So, does this have any merit? Well, not that I can think of. Now, there are smarter people than me in the room, so maybe other people can think of good reasons why this would be an appropriate place to tax. No, the only things that I could think of were these, that the value created is actually, then captured by a resident, and therefore, it should be taxed there. But that's really, that should be taxed there because of residence-based taxation, not because the value is created there. The value depends on publicly provided support. You recognise these? Okay, then charge a fee. Or that's how we currently tax, which, would be a reason, I think, if that's how we currently tax. There are costs of transition, the cost of reform. But actually, this is what the OECD says we should be trying to do, but it's clearly not what we do at the moment. So it's, in thinking kind of broadly, why do we have a business level tax at all, and what are the principles that we want to use? It's not clear to me where value creation came from. I'd welcome further discussion on that. But just a brief aside now, say, because the hot policy debate right at the moment is how we're going to tax digital giants, and so there are proposals from the European Commission, proposals from the UK, Italy, France. The OECD have recently released a report on this. So this is an issue which is in the forefront of policymakers' minds at the moment. It's not normally set out explicitly as a tax on Google and Facebook and on Amazon, but these are the companies that the policymakers have in mind. And the common proposal, and the one which the European Commission has explicitly made, is what they call an equalisation tax based on sales in the country of the user. So I think the idea of it being an equalisation tax is to say that actually there's a basic belief that these companies are getting away without paying tax. Companies with whom they're competing are paying tax, and therefore we need to equalise the treatment somehow, and the way we're going to do that is to have a tax based on sales in the country of the user. That may be somewhat wishful thinking in terms of whether they're actually going to equalise anything, because it's pretty clear that most of the competitors don't have an equalisation tax, and they may or may not be paying tax. In fact, in many cases, there are no obvious competitors to these anyway. I think the political rationale is clearly, there's a general belief that these companies are not paying enough tax. There's two versions: that they're not paying enough tax anywhere, or they're not paying enough tax here. So if the US said, actually, no, we're going to tax Google and Facebook, pretty high rates now, and they did, then it's not clear whether the European Commission would say, oh, we don't need an equalisation tax anymore. I suspect they might want to keep it anyway. But I think the other thing, and then comes back to this kind of value creation idea. If we are going to do this, we have to pretend that it's because value is being created in the place where the user is. And the kind of natural rationale for that is to say, actually, these companies are collecting data from their users, and that's value creation, and therefore we can tax it in the place where the user is. Now, is that really value creation? The US would take a different view. The US says, well, they're just like buying data. That's not value creation. They're buying data. Actually, the cost to them of buying the data is that they're providing these services, search engine or something like that. That's the cost, and that's what they're getting back. If I come to Germany and I buy something and I go back to the UK, have I created value there, even if that's useful? I think my view is, this is like a little bit like kind of counting how many angels can dance on the head of a pin. Is this really, is this value creation or not? Well, that's the wrong question, surely, because we have to figure out what value creation is first. Surely, can't we just say, actually, we could tax in the place where the user is, because the user's not going to move. So we can identify something which is immobile. That part of it seems like quite a sensible idea. We should think about that. And indeed, that's where I'm going next. But to dress it up as being this is really where all the value is created, just kind of opens the kind of big issue of, well, is it really? And then we have to figure out where value is created. That's where we are with the kind of current policy debate. This is where I'd like to shift it to. As Joel said, the destination-based cash flow tax is one of these, but there's another. So within the context of the international tax group, which I mentioned at the beginning, we've been thinking in particular about two kinds of reforms. One which we start with the existing system and say, can we make relatively incremental improvements or not? I think the problem where we make incremental improvements is that it's useful to have some idea where you're going or what a good tax system would look like. Actually, the history of all tax systems I know of is we get incremental changes all the time. We see a loophole here and we close it, and we see a loophole over there and we close that. But actually, the way that we've closed both of these loopholes has created another loophole, and now we need to close that. And that's certainly the history of the UK tax system. I suspect it's the history of most other tax systems as well. So if we want to looking for incremental improvements, we really should be kind of thinking a bit broader than that, and I'd like to think we are. So that's kind of one approach. The other approach is this kind of clean sheet approach. Say, well, what would a good tax system look like if we weren't constrained by the existing system? And then can we get there? It's tempting, though perhaps not entirely accurate, to characterize these two as being kind of, one is the kind of approach that lawyers tend to take, and one is the approach that economists tend to take. But within that international tax group, this is all joint, so we're all happy doing both of these approaches. So let me talk about each of those kind of quite briefly, and then I'll stop and see if there's any time for further discussion or questions. The common element of both of them is the destination base, which is actually, in the digital context is where the user is. Actually, that's a bit more complicated in the destination base. If we think of a kind of normal transaction where a company is selling something to a customer, this is where the residence of the customer is broadly. So, if I'm buying something off Amazon, I'm in Oxford, I'm in the UK, that's the place of destination. Why is that, a useful starting point? It's because I'm not going to move just because Amazon has to pay more tax, and presumably nobody else is going to move because Amazon has to pay more tax either. So that's different. If you think back to where I started with this kind of model of 4 places where the multinational might be thought to be doing business, all the bits in the middle it can move quite easily, and multinationals do move them quite regularly. What they can't easily move is customers, especially if those customers are individuals. Where the customers are businesses, then it's a less clear cut. Okay, so both of these proposals are going to draw on this basic idea that actually taxing in what we call the destination country is a good starting point. The residual profit allocation idea comes back to my comments about arm's length pricing. So I said arm's length pricing, if anything, it's going to identify, something like routine profit, but it's not going to identify something which might think that multinationals make over and above that, the residual profit. So anecdotally, so what the way that we might think multinationals actually organise their tax affairs is what's known as an entrepreneurial transfer pricing model. And the basic idea is, okay, they allocate some routine profit to all the countries in which they do business, but actually it's relatively straightforward for the residual profit to be allocated to a tax haven. So that's the basic idea here. It may be that this is all through IP, for example. So we put an IP. We set up a subsidiary in a tax haven which owns the IP. The rest of the business pays royalties to that tax haven subsidiary, and in that way kind of shifts all the residual profit to the tax haven and avoids paying tax on that residual profit. So the basic idea here is to say, okay, well, let's think about that model, but instead of allowing that residual profit to go to a tax haven, say let's put that residual profit in the destination country where your customer is. And then, that's the customer's not going to move. That's the tax rate that you pay will depend on the tax rate levied by the government of that in that place. And that's basically, the key difference here from the existing system. It's quite a big change from the existing system, but it's not completely, different from the way that we start off with. So essentially the 2 elements, we have to figure out what routine profit is. We're going to allocate routine profit to the places, if you like, where we might think of being value creation, where the activity takes place, where production takes place. We're going to do that in such a way that we try and get around some of the transfer pricing problems in the existing system by identifying profit as a kind of markup on costs incurred in that country, which is one of the ways that one of the OECD approved ways of doing business. So and from that we're going to exclude intercompany trade. And then residual profit in a particular country is going to be your sales minus the cost of goods sold in that country minus an allocation of costs which can't be identified and non-attributable costs, which we do by some kind of formula. So that's the idea. But the basic kind of thing to take away is just we're taxing routine profit in the place where the activity takes place and tax residual profit in the place of the destination. This would be more robust to tax avoidance in the current system because actually internal transfers wouldn't be included in the base for routine profit, and the residual profit is going to kind of use those measures for figuring out what the residual profit is, and other deductions are going to be allocated by formula. So I think we're going to get rid of many of the problems of the profit shifting of the existing system here, not all of them, and at least it's not going to be any worse in terms of kind of distortions to real activity. So there'll still be a tax in the place where you set up your factory, for example, but that tax will only be on your routine profit, which is kind of the same as the entrepreneurial transfer pricing model. It's different from where we might think, the ideal would be in a context where we're going to tax all profit in that place. So there's going to be less tax in that particular location. So at least at a minimum, it's going to be no worse in terms of kind of distortions to real economic activity, and it should help quite a lot on tax avoidance and raise considerably more revenue with kind of relatively minor changes to the existing system. So that's the residual profit idea, residual profit allocation idea. And then thinking about the destination-based cash flow tax, I'm going to do this extremely briefly, but as I said, the cash flow tax idea goes back quite a long way to at least mead. The idea of the cash flow tax is effectively, all cash flows are taxed whether positive or negative. In its pure form, it's like the government becoming a shareholder of the company. So every time there's a cost, the government contributes T% of the costs. Every time there's some income, the government collects T% of it. So it's as if the government just became a shareholder. Just like any other thing, if you change the shareholder, that's actually not going to change the way that business behaves. It's still going to try and maximize economic rent. So there should, in principle, be no impact on anything: prices, rates, returns, scale of activity, choice of debt and equity. But I thought I'd put in here a gratuitous reference to, yet one more Richard Musgrave lecturer from last year, Rachel Griffith, who, and the work that we did in 1998, I think that's one of the ones that Joel commented on, which, the idea, it says a cash flow tax has these nice properties, but actually if you're looking at location decisions and you're trying to decide, shall I put my factory in Germany or the UK, actually, even if you've got a cash flow tax on which only hits economic rent in both countries, if the rates are different, then that could still affect your location choice. So a traditional source-based tax is still going to affect location choice, even if it's only a cash flow tax. And it was really that realization which kind of led me to think, well, where else can we base the tax then? And I think the answer is, let's move to a destination base. So we start with a cash flow tax, but instead of being on a source basis, we turn it into a destination basis. How do we do that? Well, the idea is just taken from VAT. So VAT, we zero rate export. So if you produce in Germany and sell in the UK, then it's not taxed. That export from Germany is not taxed in Germany. It's an import into the UK, in which case it is taxed in the UK, just like VAT. But the only real difference from VAT is that here we're trying to tax profit, and so we're going to give relief for labour costs. So VAT, value added, is actually the sum of economic rent and labour income. If we give relief for labour income, we're just left with a tax on economic rent, and we're going to tax that in the destination country. So another way of looking at this is, the tax base is domestic sales minus domestic cost. That's all you need to know. It doesn't matter. You don't need to know about exports. You don't need to know about anything happening in the rest of the world. And at least in theory, so here's another gratuitous quote to another Richard Musgrave lecturer, the first one, I think, Alan Auerbach, and I have done some theory papers on this. And at least in our theory models, effectively nothing is affected by this tax. This really is a lump sum tax. There's no effects on any aspects of the business choice or indeed consumer choice either. Now, does this work? Well, we think it's pretty robust to avoidance, and it's pretty robust to avoidance, largely because actually internal transfers within a multinational group just don't matter anymore. All you need to know is about domestic costs and domestic income. So if we think about transfers, if we think about the arm's length pricing problem, you have two subsidiaries trading with each other. So in this case, you have a subsidiary in Germany selling to a subsidiary in the UK, for example. Well, the sale out of Germany is going to be tax-free, so that's going to be irrelevant. The price is going to be irrelevant for taxes in Germany because it's tax-free anyway. In principle, it would be taxed when imported by a business into the UK, but actually on top of that, that's a general cost of doing business in the UK, so it gets deducted again. So it's actually also a deduction. So you're taxed on the import, and then you get tax relief equal to the tax that you've just paid on and that nets out to zero. So in fact, a simpler way of dealing with this altogether would just be to ignore imports from the tax base as well. And then it becomes extremely clear that actually transfers within the multinational company just don't affect your tax in either location. It becomes much more difficult to shift profits around. And that applies to, sales of widgets, also applies to payments of royalties. And if we do the kind of VAT version of it's like the MEAD R-based, then there's no relief for interest anyway, so that channel for profit shifting disappears as well. Finally, prospects for tax competition. We've seen the kind of declining corporation tax rates. Joel talked about some of the work that I'd done on tax competition. Under a destination-based cash flow tax, if it's really true that there's no impact on the location choices of multinational companies, then changing the tax rate is not going to have any impact on the location choices of multinational companies. It doesn't matter what you do. You can reduce your tax rate to zero or make it 50%, and that's not going to have any impact on that location choice. If that's true, what you are doing, however, by moving to this system is that if this replaces the existing corporation tax, that's like the ultimate move in the tax competition game. So if Germany you'll go away and now you persuade the German government to do this tomorrow, Germany would say we're going to scrap our source-based tax altogether. And that's a pretty strong move in the tax competition game. Now we're going to collect a destination-based tax instead, but that's not going to affect location choices. So actually there's quite a big incentive for individual countries to do this on their own. And this is why the US actually thought about this for a little while before they decided it's all too complicated and they didn't quite understand it. At least not everybody understood it. I'm sure some people understood it, especially in academia. So basically, the idea is this would be stable. There's no incentive to undercut other countries. If the UK cuts its tax rate, no, that's not a problem for Germany. You don't need to respond to that. Under the existing system, you may well need to respond to that. And there's no incentive to change the system either. So this has kind of nice long-run stability properties. Okay, that's what I wanted to say. I tried to give you a kind of big overview rather than kind of focusing on any particular issues. Final thoughts. As you may have guessed, I don't think the BEPS project has solved all the problems with the international tax system. It may have reduced avoidance, and I think it probably has considerably had some considerable effect on avoidance, certainly in the kind of short and medium term. But there are still a number of problems with the international tax system. It's still inefficient, extremely complex, and is still subject to competition. And I think the final point is, the reason why corporation taxes are going down, corporation tax rates have gone down over 25 years or 30 years, is actually down to, and this comes back in a way to the political economy issues, it's down to powerful economic forces. Actually, the UK would like to attract inward investment, and so it's reduced its tax rate quite aggressively. And that affects everybody else. The US has now done likewise. Actually, if we think about those tax rates, the US has now reduced its, I think there used to be a benchmark where the US had a tax rate of 35%. Well, now the benchmark in the US is 21%. Germany's looking a bit high now compared to last year. So it's almost certain, it seems to me, that's going to have a renewed impact. Let's think of a tax where there isn't actually any competition in rates. VAT. We don't see any competition in VAT rates. It's a bit ironic that we have agreements within the EU on VAT rates. We don't have agreements on corporation tax rates, because agreements on corporation tax rates would be a lot more useful. But so actually, it seems to me that actually we could think about kind of reforming the international tax system, the corporation tax system, and moving in this direction, or we could just kind of leave things as they are. Ultimately, we're going to end up in the same place, which is corporation tax rates are going to decline and decline, and they've got to be replaced by something with taxes on things that are more immobile, which, the only things that are really left and they're not completely immobile is people. So let me stop there. Thank you.
Thank you, Mike. I would say we have maybe time for two questions, quick questions. Joel?
You said that the League of Nations luminaries didn't anticipate changes in the world in the next 100 years. What keeps you up at night about the DC?
The DBCFT. Joel, come on.
What keeps you up at night about that you haven't anticipated that sharp penciled lawyers and accountants might do to eviscerate that the way the last century has eviscerated the League of Nations?
Well, that's a good question. We've thought about that a lot, because actually, part of this US debate, a lot of people said, okay, it may be the case that DBCFT is going to close down all these avenues of profit shifting, but we'll think of others. That was a common response. So actually, John Venn and I have written a paper trying to take some of the ways that people said, okay, I could do it this way, I could do it that way, and we've gone through it kind of step by step. And in our view, the ways that people have so far come up with it either don't work, or because actually they wouldn't work in reducing the tax, or they kind of misunderstand the kind of nature of the tax or what we're trying to achieve. It may well be the case that we haven't thought of it yet, but that's the kind of I haven't come up with anything that I think will mean that in 100 years' time it won't be working. I think possibly the best way of thinking about it is like VAT. So we and this is actually what we're proposing. The DBCFT you could think of as being introducing a VAT and reducing taxes on payroll. It's the same economic effect. So we've actually had 30, 40 years of experience with VAT and taxes on payroll come to that. We know quite a lot about them. We know where the problems are. We'll get the kind of problems with the DBCFT that we currently have with VAT. Those are not insignificant. And actually digital issues are a particular problem there, where if I'm actually buying something online, and if I'm kind of downloading something, there's no kind of good crossing borders. So that's actually quite hard to tax in the place where it's being downloaded. So I think there are challenges there, but the challenges we're certainly going to face with VAT as well.
Second and final question, Nicholas.
So Donald Trump is...
Sorry, please use the microphone.
Oh.
So Donald Trump is a Republican, and he came into office and decreased corporate tax rates. And I'm wondering whether government ideology influenced the corporate tax rates. So did right-wing governments were they more active in decreasing tax rates than left-wing governments?
Well, I think there's been some work on that, but off the top of my head, and I may be misrepresenting the work here, I don't think there's very strong evidence that that's the case. Actually, it might be the case that you'd expect that, and that certainly seems to be true in the US. I guess there's other anecdotal evidence that the same thing happened in the UK. So when a Conservative government came in, they reduced the tax rate. I'm pretty sure there have been some studies looking at tax competition and trying to account for political, the political perspective of the government. My recollection is that that didn't turn out to be particularly significant in those econometric studies. And Obama proposed to reduce it as well. Yeah, from my perspective, I don't think it's a kind of right wing or a left wing issue really. And I think it kind of may appear left wing to say we should have a high corporate tax rate, and right wing to say we should have a low corporate tax rate. I don't share that view, and I think this is it's a question of economic principles and where the best way of raising a given amount of tax revenue. It's not an optimal tax problem. And the fairness issue is particularly complicated with corporation tax because we need to figure out who's actually bearing the tax. So the optimal tax question for corporation tax, I think, is more complicated than for some other taxes because the incidence is so much less. We're so much less sure about.
Good, thank you.
Okay, thank you.
Thank you, Mike. I would like to thank Joel. I won't make any comments on the lecture apart from the fact that I liked your attack on the OECD, but one of our dear colleagues at the center, just 2 years ago, went to the OECD, and her name is Georgia. And Georgia, if you're listening on the internet, I apologize for Mike. All he said was true, but nothing was directed against you. And that takes me to our musicians and the final song, which is Georgia on My Mind. Thank you.